Good morning, ladies and gentlemen. Welcome to the SOURCEBIO International PLC half-year results investor presentation. Throughout this recorded presentation, investors will be in listen-only mode. Questions are encouraged and can be submitted at any time using the Q&A tab situated on the right-hand corner of your screen. Just simply type in your question at any time and press send. The company may not be in a position to answer every question it receives during the meeting itself. However, the company review all questions submitted today and publish responses where it's appropriate to do so. I'd also like to submit the following poll, which I'm sure will be warmly received by the company if we could have your engagement. In a mark of respect following the passing of Her Majesty the Queen, before we start today's meeting, we would like to hold a minute's silence, after which we will pass over to the management team. Thank you very much indeed. And I'd like to hand over to Chairman Jay LeCue. Good morning, sir.
Good morning, Mark. Thank you very much. My name is Jay LeCue. Thank you to everyone for dialing in this morning to hear our interim results presentation. My background a bit, I've got about 20 years plus experience in life sciences across mainly UK listed life science companies. I joined SOURCEBIO in 2016 as non-exec chairman, and a year later was asked to be executive chairman and CEO in 2017. We've done a lot of work with Source over the past 5 years, which we will go through in some detail in this presentation, but we are looking forward to a very good second half and good set of results going forward. I guess I'll hand it to you, Tony, at this point.
UK chartered accountant, trained with KPMG, MBA as well. And my background really, again, similar, 20 plus years, entirely fast growth technology businesses, quite a large chunk healthcare related, but other sectors too. And hopefully a balanced mix of both operational and transactional experience and, a fair bit of time on the public markets, including AIM. And also, I think, quite a strong background in terms of sourcing acquisitions, securing acquisitions and then integrating them. So I think hopefully a very relevant experience to the journey we're looking forward to going forward.
So just a quick executive summary of the business. We're a leading provider of clinical precision medicine and drug development lab services to blue chip pharma, NHS, and private healthcare providers. H2 or H1 of this year, our focus was on accelerating the core business. As some of you may know, we were very involved with COVID-19 PCR testing during the pandemic, and we have transitioned away from that and are definitely more focused on the base businesses, which are doing very well. There is a significant opportunity in cellular pathology and digital pathology that is materializing. In fact, again, for those who don't know Source very well, we had sort of hedged into COVID to protect the business against the decline in elective surgeries that happened during COVID. Well, now that COVID is moving away, we're seeing those elective surgeries come back online into the system. So you've got a significant amount of growth in that segment that we believe will continue in the years to come. Our cost base also was significantly reduced in H1. We were, a much larger business with our COVID side, and we have scaled it and right-sized the business to fit the current business and allow us to also do some steady growth over the next years. Our first M&A deal, which was the result of the cash generated by the COVID activity, was LDPath, which means London Digital Pathology, closed in March. Integration's going very, very well. The 3 founders are staying with the business. It's outperforming plan. In fact, it's outperforming our expectations, which is good to see. We've got a strong balance sheet, enabling us to invest in the business and also continue to look at strategic M&A. And then below is just a sample of some of the blue chip clients we have, just to give you an idea of the level of quality that our customers would expect from a company like Source.
Okay, just to fly through some financial highlights. We're obviously going to spend some more time digging in the detail. I think, as Jay alluded to, I mean, the first half has been absolutely about pivoting away from what was a very spectacular PCR business towards where we are now, which is absolutely pushing hard, aggressive growth in our base business units, which are healthcare, diagnostics, genomics, and stability storage. So we're going to talk to those each in detail in turn. But as you see from the headlines here, if we look at those three base business units, very strong growth, like for like, 74% up in the period versus the prior first half. Particularly, the star in the portfolio is absolutely healthcare diagnostics. That grew 4 times in the period, up to 6.8 million from 1.7 in the prior first half. And that, as Jay mentioned, that does include an acquisition. Again, we'll give you the analysis of where the revenue is coming from, organic versus inorganic. But again, a successful acquisition. They've absolutely met and exceeded expectations, trading actually 14% above the growth plan that we set them. Genomics also has grown 11% and stability storage 9%. Again, we'll come and give more detail. And just to pick up the point that Jay raised, significant cost reductions. Absolutely, we've again through a period of transition, we've certainly addressed both the the quantum of cost that supported the PCR business. So that's what we call the variable cost, the kind of the lab staff generating that revenue. Clearly, as the PCR business has declined, that cost has come out. But importantly, we've also addressed the expense base as a whole, which we've referred to as SG&A. And in truth, it's not the sales element of that, really. It's the general and admin element that we've addressed. So in overall terms, what I can say is that the SG&A costs of the second half of last year, 2021, were about 7.4 million. We've tracked those down to 5.5 in the first half, and some of the further savings we made in the back end of the first half, in fact, will obviously feed through into the second half. So we expect that to be less in the second half. So I think the way to look at this is it's going to be very clearly second half weighted, and that's a combination of the dynamic really growth of particularly of the healthcare piece, building the top line as we go through the year. And then add on the benefit of obviously a reduced cost base, particularly in the second half. So I think that's really the flavour of the year. First half is about transition. Second half is about delivery of stronger bottom line weighting, by driven by those two factors. And clearly, we've managed as well the balance sheet and particularly inventory as we've come out of PCR. And what we're left with a pretty clean balance sheet. That's absolutely dominated by cash. So we've still got strong firepower to build the business organically and inorganically. And just to highlight, it's dominated by cash, 15 million, and in fact no debt whatsoever. Okay, so again, just to give you some of the revenue components. Again, we'll come back to each business unit in turn, but you can see again, so the split of the 74% core business unit growth is shown here across the 3 business units. So underlying strong growth. And I think just to reflect, I mean, obviously in absolute terms, the COVID piece, the infectious disease testing, are strong numbers at the bottom there. But our focus going forward is absolutely on these 3 business units. And that's where we're concentrating on the presentation. And what I can say is that the pace of growth has very much increased half year on half year, so that actually the revenue growth, although it was 74% against the first half of 2021, we grew actually 43% against the previous second half of 2021, which grew 21% over the previous 6 months, which grew 15% over the previous 6 months. I think what we're saying there and demonstrating is actually an accelerated growth trajectory.
Let's talk outsourced pathology and the way we're viewing the market opportunity. We've been saying this for years on the CellPath side, that it is really the crown jewel of the business, and it is becoming more so as we develop this opportunity. So number one, you've got the shortage of pathologists in the UK, and actually it's worldwide, which is pushing this trend to outsourcing. There simply is not enough capacity within the NHS to do the amount of testing that they need to do. They'll turn to companies like Source to help them out and be a partner with them. on decreasing their workload. Then you've got the COVID-19 situation where the elective surgeries were delayed, and those are now coming back into the system. And as I said earlier, there's just a massive bolus of new cases coming in that should have been done over the past few years, and they're coming in now. So it's a significant increase in volume. On top of that, now you've got the growing pathology market, which is a result of a growing population. There is more testing, there is more skin cancer. So that's just growing by itself at a rate that is 10% plus. And then on top of it, you've got this structural shift to digital pathology and artificial intelligence. That's what AI means. And it's happening much faster than even we had expected. And it only makes sense because you can use digital pathology to send images around the world. You don't need to have slides being sent back and forth via courier. And it's just a way to help minimize the significant amount of backlog we have in the system. AI also allows pathologists to do a primary screen on tissue samples that have been digitized, and then prioritize their focus on the cases that are most acute. So that is happening much faster than we had thought, and we are on top of that with the acquisition with LDPath that has both digital pathology and AI capabilities that we are continuing to invest in. Another opportunity is this digital LIMS leasing activity where we will be leasing NHS trusts and potentially private hospitals our LIMS system. That means laboratory information management system, where they would just leapfrog using our system into digital rather than setting one up themselves. And we've had interest from several NHS hospitals about doing that as soon as possible. So we think that's a new revenue stream, a new business model that we're going to look at and develop. Just so everybody's clear on what digital pathology means, we always like to assume people do, but just to give you a graphic, I mean, traditional pathology, you take a tissue sample, you put it in a microscope, you've got to send that slide around to another pathologist, and you've got days of time in between, preparing the sample and getting a final diagnosis. 5 to 7 days is average. Sometimes it can go up to 15. Digital pathology, you get the tissue sample, you digitize the image, and immediately that image can be sent to 1 or 2 or 100 pathologists, and in some cases anywhere around the world, and you just have a much faster diagnosis. In fact, Source LDPath pathologists report results in less than 24 hours. So we are moving from a 5 to 7 day turnaround to a less than 24. We're saving 4 to 6 days. The global digital pathology market is expanding about 15% a year, and the UK, we believe, will be even faster than that. The US is faster than that. So I think we're going to see some rapid growth coming out of the global digital pathology business that will very positively impact our business going forward. Tony, I'm going to let you take this one.
Yeah, happy to take this. So, I mean, obviously, we've already put the details out of the transaction, some months ago. But just to elaborate a little bit. So, essentially, it was an all-cash transaction, and that was very much at our choice. But whilst there was an upfront consideration, I think it's fair to say that it's very meaningfully loaded towards earn-out payments, which I'll say are driven entirely by revenue. Actually from acquisition date to 31 December 2024. And I think in very, very broad terms, we've assumed, as you'll see in the RNS, something like 5 million of earn-out payments or deferred consideration. And that's really related to very roughly doubling the size of the business. So, again, a very aggressive revenue outlook, I think. And as you've also seen, it's early days, but 3 months in, the guys are already exceeding plans. So we're delighted with the deal so far, and we think there's actually a lot of upside behind, to come. And what I can also say is, clearly we've had 3 months to bed the business in, work through integration, etc. And confirm, no horror stories to date. And we're delighted with the deal, and obviously keen to pedal a bit faster as well.
So just sort of an overview on Source LDPath. Key strategic acquisition, creating a dominant position in the market. Source was a very large player prior to the acquisition. When you add on LDPath to the Source offering, we are now the leading provider of outsourced cellular pathology services in the UK. 70% of LDPath business was from its digital platform. We talked about the reduced turnaround time, but that means in aggregate now something like 35 to 40% of our business is now digital. That's a big positive that is growing rapidly. There are strong growth opportunities. We talked before about the shortage of pathologists, the backlogs, and the migration to digital, so I won't be going over that in any detail now. It was earnings enhancing on day one. It's trading well above plan. The plan is to accelerate conversion of both NHS and private clients to digital as soon as possible. We are bringing in artificial intelligence offerings into our offering, and we are looking at this LIMS technology services offering, as I mentioned before. The strategy is to use our growing digital platform to secure nationwide and regional contracts. We've got a gentleman on our board named Sir Ian Crothers. He used to run the NHS. He's giving us some direction on how to get it up at more senior levels within the NHS to do more aggregated roll-up, so to speak, of our digital platform. And also we can expand internationally by putting a scanner in, let's say, Australia, Canada, India, anywhere where there's a Royal College, rarely Royal College trained pathologists, and we can utilize those in the UK, and we can utilize UK pathologists in those countries. So that's another opportunity for us to grow this business internationally. We just show this graphic as an indication of how we're communicating this to our customer base. I always sort of like to use this analogy. Source, very established business, been around a long time, excellent quality systems, ISO 15189, accredited by UCAS, et cetera, primarily in the wet lab space. Then you've got LDPath, really focused on digital, focused, I would say, more on the private healthcare market than the NHS initially, AI technology. They're sort of the SpaceX of the space. Source is sort of the NASA of the space. You put the two together and you've got a very competitive and compelling offering. And I can just tell you that this Source LDPath offering that we've created and taken the best of each division, or each, I guess, business unit, is being very well received by our customer base, and we are seeing conversions to digital at a rate that we didn't expect, and it's very positive to see moving forward.
Okay, just a few words on the numbers in relation to healthcare diagnostics. So here you can see the revenue breakdown on the left-hand side, margin, and so on. And here I've tried to break down, really. Remember, we mentioned the 311%, the 4 times growth in revenue. I've tried to split the organic versus inorganic. So what you can see is the organic has clearly grown 179%, like for like. Apologies, I didn't actually put the number on the presentation. I should have done, but the like for like comparison of LDPath is essentially 82%. So whilst it was pre-acquisition, essentially that 2.2 million that they did in the 3 and a bit months of this year was actually 82% higher than the equivalent 3.5 months of the prior year. So again, strong growth in both areas, and obviously we aggregate them post-acquisition. I think maybe I'll just point you right towards the chart there, if I could, on the bottom right-hand side. So this is really a graphic illustration of the monthly revenues, which you could really, is analogous to the throughput and the volumes. And you can see here that through 2021, clearly, as we're coming, through the worst of the PCR, COVID, issue, the volumes are starting to come back at a certain gradient. But I think what we're seeing is in the start of this year, essentially the gradients are absolutely steepened. And the blue line represents essentially our organic cellular pathology business. And the orange line, which is obviously additive, is the acquisition of LDPath, which we've included obviously from the point of acquisition. And maybe another way to look at this is, in revenue terms, what is the sort of the ongoing annualized rate? Well, what I can say is that at the end of December 2021, or the start of this financial year, January 2022, we essentially did a little under £500,000 of cellular pathology revenue. So that was actually 5.8 million of annualized revenue from this business. And again, just the organic piece, the CellPath piece, by the half year, we're doing essentially 10 million of annualized business. And if I add to that the orange piece, the LDPath piece, that left the first half doing about 7.4 of annualized business. So that aggregates to about 17.5 million of annualized business at the end of the first half, compared to the 5.8 at the first half. At the start of the first half. And what I can say is, I can't give you the precise numbers, but for July and August, I can say that, for both of those months, we've tracked north incrementally for both of those months. And obviously that's our plan, is to incrementally build that throughput, build that sort of capacity, build the people, etc., and build revenues month on month. So yeah, it is a function of laboratory space. It's a function of people. It's a function of consultants. It's a function of getting the business in. Absolutely. And I think if we're honest, the fundamental challenge we have at the moment is hiring people fast enough. We think the business is there. We've absolutely got the lab space. We're repurposing PCR lab space, which is at our fingertips. So that's all helping. We've got the external consultants. So it's a question of bringing people on fast enough, and that's our honest management challenge. And where we can potentially make step changes going forward is really about altering shift patterns and increasing our numbers of shifts, etc. Make step changes. So again, I think there's a lot of upside going forward as we're thinking about accelerating the pace of this growth. And I think the final point on this slide I'm going to make is really on the gross margin. And you can see here that the upward trend in gross margin. So whilst at the first half of 2021 we're about 24% gross margin, full year gross margin was about 35. We're now at 40. I mean, to be entirely honest, we think 40 is really the baseline. It should be 40, and that's a function of volume clearly. But as we start to increase the private element as opposed to the NHS element, that has an upward benefit on pricing, and therefore that's going to improve the margin. Obviously, as the digital component increases, that essentially reduces cost, so that has a positive effect on margin. And obviously, generally, increased volume typically does make the space and the volume efficiencies more attractive. So we think there's upside on margin going forward, and we're certainly mindful of balancing wage inflation with pricing, etc., etc. So again, we've got some honest challenges, but we see a lot of upside in both revenue and gross margin in summary.
Good. Let's talk genomics, source genomics. We consider genomics to be the study of genes to progress clinical research and drug discovery. In this market, outsourced is the preferred model. Most biotech and pharma companies don't want their staff running routine sequencing. They want to have them looking at the results of the sequencing, helping develop drug compounds and new disease states to focus upon. So what we're offering from a genomics perspective is Sanger sequencing, which is an older technology developed in the 70s. It's one strand at a time. However, it is still the gold standard in clinical research, so there's a lot of demand for Sanger. We're very good at it. We have the best turnaround time in the industry, and it's a 50% gross margin business for us. Next generation sequencing is when you talk about whole genome sequencing. That's where the market is going. That's where the developments are going. So we are definitely focusing our efforts on growing that side of the business. But at the same time, we're also looking at other types of services to support Sanger. I won't get into the detail, but such as extraction services that'll help grow that business as well. We are moving our facility to a much nicer building in Histon, which is just outside of Cambridge. Much better facility. The facility we have now is a legacy acquisition facility. It can do the job, but we're maxed out, and it really is not customer friendly. This new site will be much bigger, much better process flow, and much more customer ready. We want to bring in customers for training and doing some presentations. We have invested in equipment, and we've got a NovaSeq up there, but we've also got an Oxford Nanopore system that we just offered. So we're really equipment agnostic, and we'll offer people whatever a solution they would like as far as an outsourced lab capability. We do have an excellent commercial team in this business. They are very credible and very capable of quoting business, managing customers, and managing a pipeline. I mean, I have to say this is a pretty strong commercial team that's really helping us grow the business. And another thing that we have done more recently is put together a dedicated precision medicine business line, which focuses on, I would say, more proactive healthcare. And one example would be EndoPredict, where you can take a tissue sample, sequence it down, and figure out what's the best chemotherapy treatment for that particular cancer patient. Or one that it might even be toxic and you would not use that. So that's a much more proactive way to manage healthcare, and that is where the market is going, and we're going to make sure we're there to support that type of healthcare initiative. Here's the picture below is a snapshot of the site. We're very excited. We expect to be in there by, I would say, November of this year. So next year, we're going to see some upside from being in the site. We are moving more to NHS, as I said, versus Sanger sequencing. However, I want to make sure that we're clear that we are staying in the Sanger business, and we will put services around Sanger to help support the growth of that business. One other thing that we did want to mention, and we haven't mentioned it before, is that while we are moving sequencing into San Diego, we've got a facility in San Diego, California, in the United States. The plan had been to put sequencing in San Diego. We used to have a facility in Los Angeles, and the lease was up, so we were moving to San Diego. We were getting ready to put in a sequencing capability, and COVID hit. So then we actually stopped the sequencing initiative completely, looked at COVID. Now that COVID's over, we're getting back into sequencing, and we're putting a sequencing capability into that facility. And for those of you that don't know, San Diego is the sequencing hub on the West Coast of the United States, if not the entire United States. So it's a very good place to be to grow the business. So we will be having Sanger as our initial offering, and then getting into NGS as we grow that business. So we're looking at that as upside, because it isn't really in the forecast at this point, but we're expecting a lot out of the San Diego opportunity.
Okay, just again taking a few moments for the financials for Genomics. You see here the mix of revenue and the margin, and I think, again, we've got some analysis really on where that 11% revenue growth has come from, and what you can see, I think supports Jay's narrative really. We've absolutely strategically focused on building NGS and growing precision medicine from a modest start. So that's where the focus of growth is. And Sanger has come down a little bit. I mean, Sanger is perhaps more of a commodity offering, so that's not our focus for growth, but it's still an attractive business. So, in overall terms, 11% growth. I think what you can see is that the mix has impacted the margin. So I think what we can say is Sanger is a 50% gross margin business, similar to last year. So that's been sort of fairly consistent. NGS is growing in terms of gross margin. It's grown from 23 to 25%. So it's certainly trending up in the right direction. It's not where we want it to be. I think it's very clear that as we get more scale, we can become more efficient using plates, etc., and general, again, economies of scale, being able to select larger projects, etc., and of course the benefit of price increases that we've recently effected. So I think we fully expect margins on the NGS to morph upwards. Likewise, precision medicine as we get more scale. So we'll start to correct margins, I think, in those areas. I think, in honesty, we're not going to get NGS to 50%, but if we can morph it from 25 to high 30s and perhaps 40 over the coming year or two, I think that's an honest sort of assessment of where it probably should be. So we're pleased with progress. I think, again, to be honest, the challenge really is gross margin. We know what we have to do, and we've got a number of initiatives in place. I should say also things like buying consumables in sterling, not dollars. There's a number of things that we're working on, and that is our focus, to build this gross margin.
But Tony, before we move forward, I want to make sure we're clear on this. We look at sequencing, and yeah, people call it a commodity business, but the fact is it's got 50% plus gross margin, and it is a growing market. So we are going to continue to focus on Sanger and build that business while we underpin it with the growth from NGS. And yes, there are margin improvements we can make. And as Tony said, we will not probably get to 50% on that margin initiative, but with other tests and precision medicine and some other higher end offerings, we will get the gross margin up. But I just want to be clear, Sanger, is going to continue to be an important part of our business, and we're going to do what we can to grow that business. Let's talk stability storage. Stability storage data is a regulatory requirement for drugs and consumer products to be released to the market. So what that means is you need to have stability data on the compounds and on the finished product of what is being offered for sale to consumers in various humidity and environmental temperaturely controlled environments that mimic conditions around the world. We are able to offer that in 3 of our facilities, one in Rochdale, one in Tramore, Ireland, and we've got some space in California. And it is a high margin. It's basically a mini REIT. You've got a high margin recurring revenue business. Contracts are 3 to 5 years. And it is almost an annuity stream to not oversell it. We've got 2 real revenue streams, both to pharmaceutical and consumer healthcare client base. Storage services, where they're putting their products in our facilities to store for them over time. They come in once a month, once a quarter, depending on the SOP, and do a test to make sure that product or compound is stable. We also do stents. We do medical devices. We do many types of things in our storage facilities. We also have service and validation of equipment. We used to sell equipment. We've gotten out of that business, but we are still servicing that equipment. So that is an important part of our business going forward. Storage is really driven by capacity, and we've invested in both Ireland and the US. That gives us additional growth space. I already talked about the long-term contracts, which really makes this more of an annuity stream. And the upgrade service opportunity, we believe we're going to look at servicing other people's kit, which we are finding could be a very lucrative additional piece of this business that we haven't really looked at previously.
Okay, again, a few seconds on the financials, and really just following on some of the messages that Jay just made. You can see here the analysis of the revenue in the mix. And again, just to be clear, the storage services, this is where clients are leaving their products in our facility. That's clearly the biggest part of revenue. And this is where we essentially have recurring revenue from long-term contracts, and it's highly profitable. It's essentially 81% gross margin, and that's been actually consistent throughout the periods that we're reflecting here. So that's a very robust business. And I think importantly, it's a recurring model. We can add slices of incremental revenue with really little or no incremental cost. So I think that's the business model there. Service and validation that you see. I mean, this is typically a 44% consistent growth margin, in fact, through this period. And the two of those businesses together get us our blended 65% or so gross margin. So again, this business is about visibility, recurring revenues, and high profitability. And it's been robust through COVID and is poised to be built further. I think actually it's a general comment throughout the organization. I mean, we've obviously used the proceeds of PCR testing to make the capex investments that all the businesses need to grow going forward. So essentially, it's not a capital intensive business going forward. We've added incremental space in San Diego in the US. We've added incremental space in Ireland for stability. Our Rochdale facility already had the space, so the space is there for them to grow. And likewise, investments have been made elsewhere. You've seen for genomics and healthcare for them to grow going forward.
So summary and outlook. So H1, we believe, was very encouraging from our perspective. We pivoted from PCR into aggressive growth of our core business units, unprecedented market opportunity for cellular pathology. We knew this was coming. We communicated this was coming to investors in the prior periods, and it is now materializing at a rate that was that's actually greater than we would have expected. The LDPath acquisition is completed. Integration's ongoing, but I will say it's delivering above plan. The three founders have stayed with the business. It's just a great additional business to have as part of our offering. We've right-sized the cost base. That will have a much stronger benefit to the bottom line in H2, as we've talked about. There's encouraging future growth in precision medicine and some genomics activities we're looking at. We've got a very strong balance sheet capable of supporting both future organic investment and also M&A. We are debt-free, as Tony mentioned, other than leases, with a closing cash balance of 15.2, and we are involved right now in a busy H2. So with that, I will turn it back over to Mark and open it up for questions.
That's great, Jay, Tony. Thank you very much indeed for updating investors. Ladies and gentlemen, please do continue to submit your questions using the Q&A tab situated on the right-hand corner of your screen. Just while Jay and Tony take a few moments to review those questions submitted already, I'd like to remind you that a recording of this presentation, along with a copy of the slides and the published Q&A, will be available via the Investor Meet Company dashboard. Jay, Tony, you have received a number of questions throughout today's meeting. I haven't given you a lot of time to maybe open up the Q&A panel, but if I may just hand back to you to read out those questions and give a response where it's appropriate to do so.
Yeah, let me take a look at these, Mark, and we'll look at this. There's a question on the genomics opportunity. Why you are expanding here, the benefits, et cetera. We think genomics is a significant market opportunity, and we really, I don't believe, have looked at it in a way that we could be much more strategic in how we develop the business. I would say 5 years ago when I got involved, we were primarily academic with small amounts of business with a few biotechs and large pharma customers. Now, our customer base is primarily large pharma and biotech and much reduced academic customers in our base. So we are working with our larger customers to develop their systems and drug development programs as they develop drugs, and we are supporting that activity. So we do think it is a huge opportunity. There is drug development going on. We are getting involved in clinical trials. The Sanger sequencing bit, as I mentioned, is a high margin business for us, and there is opportunity. The Oxford Nanopore system, for example, is getting some traction in the market. We're offering that. So we believe it's a nice opportunity for us to expand our business in a way that we weren't able to do a few years ago. I think we've certainly invested in KIT, as Tony said, and we are making sure that we're making returns on that investment. There's a question about, would you consider acquisitions to grow your precision medicine business? Yes, we would. That's a very good question. Certainly, we're looking at CellPath. We would look at an AI capability to buy. We might look at a lab space somewhere if we needed to increase our capacity, which we likely will. But certainly, if a precision medicine opportunity came up, we would take a serious look at that. So that is a good point. Probably something I should have brought up. We've got a question about share volume. Yes, we don't have the most liquid stock. We've got a few large shareholders, and we are looking at ways we can improve upon the execution of our business with such I would say a low level of liquidity is probably the best way to put that. And there's another question that's similar to that. So I think I've answered that one. Now, Mark, I'm getting lost in these questions here.
Yep. No, you've done two of the questions were around the same topic, around liquidity and valuation, which I think you've covered off. And the other questions I think you've also responded to, and I think they've been just archived for the time being. So Jay, may I thank you for your time this afternoon. And there's just one question there from Mary. I don't know if that's...
Yeah, I can take that. Are there any plans to start paying a dividend? I can say right now there are not. We are looking at ways to use the cash to both invest in the business and grow via M&A. So we would certainly consider maybe a special dividend if we are sitting here 6 months from now with cash on the balance sheet. But I think we've got some pipeline potentials that may help us grow the business in a way that might be better for shareholders than handing out a dividend at this point.
That's great. Well, look, Jay, if any further questions do come in from investors on the basis you've cleared up all of those that have been submitted, I'll make those available to you after today's meeting. I know investor feedback, as usual, will be very important to both you and Tony and the board, and I'll shortly redirect investors to give you their thoughts and expectations. Right. But if I may, Jay, just ask you for a few closing comments just to wrap up with, and then I'll pick up from there.
Sure. I mean, we're excited about the H1 results here. We are executing on the LDPath acquisition. We're seeing cellular pathology grow in ways that are even exceeding our expectations. We've right-sized our cost base, which will impact us into H2. So we are very bullish on the business going forward. I guess I just wanted to close with that.
That's very kind, Jay. Thank you to you both for your time today and for your presentation to investors. Can I please ask investors not to close this session, as we'll now automatically redirect you for the opportunity for you to provide feedback in order the company can better understand your views and expectations. This will only take a few moments to complete, but I'm sure will be greatly valued by the company. On behalf of the management team of SOURCEBIO International PLC, I'd like to thank you for attending today's presentation. Good morning to you all.